I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a regular guest. He's on all the time. And I bring this up. He wrote it back in 2013. And it's he's an economist. He is a money manager. The coming bond market collapse. I'm giving it away. You could have written this book last week, minus, I think, the negative interest rates that are completely crazy. He's laughing. But he lays it out. He laid it out perfectly. He was just early. But smart people are always early. Michael Pento of PentoPort.com, Pento Portfolio Strategies, money manager extraordinaire, economist. Hey, thanks for joining us today on USAWatchdog.com.
As always, my pleasure to be back with you, Greg.
Let's talk about the yield curve. I know it's kind of boring, but, I'm a dumb guy, and I go into, I don't know, back in my hometown, Bank of Monroe, and say, I'd like to have, a really short interest rate. Okay, great, Mr. Hunter. We can give you 2.09%. Great. How about if I drag it out longer? Well, let's see. If you go out to 10 years, hold on. You can get, you can get a whole 1.74%. Wait a minute. That's less.
Yeah.
What's going on with the interest rate curve? 2.0.
Right? Sorry.
What's going on? What's going on with
well, listen, first of all, you asked me what's going on. The central bank charade is over. Okay, remember back in the Great Recession, they took these emergency measures. They said they were going to be temporary in nature. They are not temporary in nature. You're talking about mortgages. You can go to Denmark right now and get a mortgage with a negative interest rate. That's how corrupt and backwards the interest rate spectrum is right now. There's $15 trillion worth of negative yielding sovereign debt. And we were told at one time by Mr. Richard Fisher, formerly of the Dallas Fed, who said the United States is not a banana republic. And he claimed, went through what some of these banana republics once did. They print trillions of their currency units, and they had a hyperinflationary collapse of their currency and a hyperinflationary collapse of their economy. And the United States will never do such a thing. Well, if you remember, after the credit crisis, we had an emergency temporary measure where we printed $3.8 trillion worth of counterfeit money, confetti money. But that was temporary. We were going to drain that balance sheet. We're going to take all of that money back, Greg. Remember?
Yep.
Well, guess what? The quantitative tightening program was cut short. It was ended in July, on July 31st, when the Fed actually cut rates from 2.25 to 2.5 to 2 to 2.25 on the Fed funds rate. And they were only able to take away $700 billion of the $3.8 trillion that they created. So there's $3.1 trillion worth of base money supply, that's rocket fuel, real money, in the banking system, dry tinder, ready to explode to a hyperinflationary crack-up boom. And they did it on a permanent basis. And the Fed funds rate that was taken to zero and left there for about 8 or 9 years, was supposed to go back to its average, which is around 6%. They only could get to 2.25%. And now we're headed back towards zero. That's why I say you and I have gone through a little bit of vindication. I've come on your program for years. You've had your program for years saying, hey, something is rotten in Denmark. Well, it's not just mortgages that are rotten in Denmark. The entire artificial construct of the global economy, which is predicated on free money, has served to create massive asset bubbles and rendered the economy in a debt-disabled situation. That cannot end well. It isn't ending well, and it's unraveling now. Vindication for you, my friend.
And for you, they have. I had Bill Murphy on, and he said that listen, they're being overrun in the COMEX. They still control it, but they're being overrun. The rest of the world is the gold cartel, the ESF, Exchange Stabilization Fund, the Fed, Bank of England, all that whole thing, LBMA, COMEX, that whole mechanism of suppression, he says, is being overrun, and it's going to get worse for them. What
Well,
say you?
well, gold is on its way back to a nominal high, in my opinion, here in the United States in US dollars. It's at a record high in a multitude of currencies around the globe.
Yeah, he said that.
Even silver is catching a bid. So the game is over. Gold is real and honest money. It's revealing the fraud that is being perpetrated upon the global citizenry. The entire yield curve, talk about being in the twilight zone. The entire yield curve in Germany and Japan is negative. So when I say yield curve, I mean from overnight lending all the way out to 30 years. Money has no value. Loans have no value. It's a negative value. Many European Union nations are joining Germany in that very uncomfortable rubric of having negative yields. And that's just on a nominal sense. In a real sense, these yields are negative, and not only negative, but profoundly negative and headed more so. I want to talk to you a little bit about Donald Trump and Treasury Secretary Steven Mnuchin, and the Federal Reserve. So we have some members of the Federal Reserve. I'm thinking of Charles Evans from the Chicago, president of the Chicago Fed, who's actually panicking. He's saying that the way the government measures inflation, which is the core PCE deflator, since it's below 2% and has been that way for several years, we, the Federal Reserve, has to show the middle class of the United States that we could get inflation above 2% substantially and keep it there and get it there quickly. Now, I'm going to just tell you that another measurement of inflation by the government is called the Consumer Price Index, CPI. That came out today, Tuesday, and it was 2.2% year over year on a core rate.
Whoops.
And you know that the year over year core rate of inflation has been above the Fed's target for 17 months in a row? And yet we have a Federal Reserve that's panicking to get back towards zero, that's demonstrably anxious about getting above 2% now and maintaining it the way they measure it for a very long time. We have Trump saying in a tweet that you would think, I'm paraphrasing, that you would think as president, I like a strong dollar. Well, I don't, with an exclamation point. You have Treasury Secretary Steven Mnuchin saying that he might not use, well, he says, and I'm paraphrasing again, we're not going to use the ESF, the Exchange Stabilization Fund, yet. But I think in an emergency situation, Trump could declare a national emergency, use the ESF to buy Chinese yuan. There's not much in there, by the way. There's only about 20 billion of dollars. He'd have to get the cooperation of the Fed, which he's not getting right now, the way he wants it, and the PBOC, and they're not going to give him a hand. So what he's going to do is probably maybe declare a national emergency and replace Jerome Powell for cause and get a real money printer in there. But the point I'm trying to make is, and I'm not using hyperbole, I'm just saying what actually could happen and what is desirous of our Treasury Secretary and our president. They want the dollar weaker, and they want interest rates down to zero, and they want inflation up as fast as possible. They want to join the rest of the world in their lunacy. And we're supposed to believe that things are normal, that things are fine and dandy. One more point I want to mention is what you mentioned, the yield curve. Well, prior to the Fed cutting rates, so one would think that when you cut short-term interest rates, that's inflationary, so longer-term rates should rise, hence the yield curve should widen. Well, the yield curve was 20 basis points between the 10-year note and the 2-year note. It was over 20 basis points prior to July 31st. And then the Fed cut rates by only 25 basis points. That wasn't enough for the market. And guess what the spread between the 10 and the 2-year note is now? It's just 4 basis points. It's almost inverted. And the inversion between the overnight lending rate, short money, which is over 2%, and the 10-year note has been inverted got way more inverted after July 31st and has been that way for over 3 months.
And my question, go ahead.
And when you have an inverted yield curve, the overnight lending rate, short-term money, 1 month, 3 month overnight money, and the 10 years inverted, more than 3 months, the countdown to recession is on. Historically, every time that has happened for more than 3 months, we've had a recession, and it usually occurs a little over a year. So, in a year from the initial inversion. So we're about maybe 9 months away at most from an official recession. And why do you care? Who cares about a recession? Well, the last 2 times it happened, in 2001, the NASDAQ dropped 85% or over 80%. And the last 2 times it happened, the S&P dropped 50%. And we are way overvalued today than we were in 2007. That's why you should care about a recession.
What is going to happen to the guy? I ask this question all the time, and maybe you give me a good answer. What's going to happen to the guy on the street? What's going to happen to little people like me and some of the other people watching this show? There's some big people watching this show too, but what's going to happen to the common man if this? We have so much debt that even if a small recession, isn't that going to? Tell me what could go wrong?
Well, it's not funny. It's actually very sad. I don't want anything bad to happen to this great country, but you could ask that same question about the NASDAQ in 2000. It's like, that's only owned by rich people. Who cares if the NASDAQ loses 80% of its value? Who cares if home prices, home prices drop 30%, but that's only going to affect the subprime mortgage borrowers and those who have margin loans. They're loaned out 5 homes on margin. That's only going to affect them. Well, it affects the man on the street, because when you have a recession and when you have an overextended leveraged economy and market, it tends to affect you directly and affect you in the worst way. So here's what I think is going to happen. So the nucleus, the salient over leveraging of the U.S. economy is most manifest right now in the junk bond market, in leveraged loans, and in triple-B debt. So we have $5.4 trillion in that rubric of CLA, collateralized loan obligations, CLOs, mortgage-backed securities, junk bonds, and loans that are rated triple-B, which is one notch above junk. 5.4 trillion, Greg. We had only $1.5 trillion worth of so-called subprime mortgages. So what's going to happen during the next recession is, it's okay, maybe it's okay in Europe to have 14 companies with a negative yielding junk bond. And maybe it's okay if junk bond yields in the United States here are only a few hundred basis points above treasuries, above sovereign debt. But when you have a recession and you're only getting 4 or 5% from a junk bond, okay? And then you understand that the company that you've given your principal to is going bankrupt for sure, then you tend to want an interest rate that's way higher than 4%. And as a matter of fact, when you are cognizant of the fact that your junk bond that you hold, its principal, is going bankrupt, no interest rate is good enough for you. So what do? You panic and you sell the triple Bs. Triple Bs become junk. You sell your junk. Interest rates soar because of that recession. Layoffs diffuse across the entire employment spectrum of the U.S. economy and the global economy. And your stock portfolio, if you have one, gets cut in half and then some, and you're out of work. And then on top of that, if that wasn't bad enough, same thing that happened. We had millions of people that lost their jobs in the Great Recession. Deficits went to $1.5 trillion per annum. There'll be almost $3 trillion per annum after this happens. And then on the back end of that, since you don't have a job, you in the middle class, you've been laid off, and your 401k has become a 201k, as they say, again. And then on back of that, you'll have the Fed and the Treasury doing their best to wreck the value of the US dollar. So you're going to have stagflation, like we've never seen before to help you out. How's that sound?
Oof. And this is not a maybe. I mean, the die is cast. The debt is there. We have what you called what? Debilitating debt, crippling debt,
Disabling debt on a global
disabling.
basis. It's profuse in China, Japan, the Eurozone, the United States, throughout the developed world. And you cannot service this debt honestly. In other words, the tax base available in the European Union, Japan, China, and the United States cannot make this debt solvent. So it has to be defaulted upon. It can be defaulted upon through either inflation or deflation. I think they're going to try both. They tried deflation. It's happening now. It's not working out so well. After this crash becomes completely manifest and particularly salient, they'll switch towards inflation. And I mean inflation like we've never seen before. A strategy to get to inflation, not just, they gradually take the interest rate down and the Fed funds rate to zero. That's not going to work. They'll probably launch another iteration of QE. That's probably not going to work because that's going to sit and lay fallow in the banking system. They're going to have to do modern monetary theory, negative interest rates, helicopter money, the banishment of cash, all those things that I've been saying. I mean, I've been coming on your program for several years. I laid this out very clearly what's going to happen. We are seeing a recession. Gold is spiking in a huge way. We have disabling debt levels across the globe. We have the bond prices that have skyrocketed and the yields have crashed. We have the inverted yield curve that I predicted. We have a global recession. It's a fact. It's a global recession, a global manufacturing recession, and a manufacturing recession here in the United States that is starting to spill over into the service sector economy. So all the things I predicted are starting to pan out. It's taken some time because I at the time I wrote that book, never envisioned the degree in which central planners would go to avoid this inevitable cathartic recession.
I mean, if you told people 10 years ago, and this is long before you wrote this book, that we would be, they're going to go to negative interest rates on sovereign debt. Oh, come on, they're not going to do that. You're going to pay them $100 and you're going to get back 95 or something? What? No. Yes.
And
Yes.
and if you're a pension fund or someone who has on your buy side, wirehouse edict that you must own a certain amount of bonds in your portfolio, and you're buying negative yielding junk bonds in Europe only because you know that you're never going to make any money if you hold it to maturity. You're only hoping that some other idiot comes behind you and buys the junk bond at a more negative yield. I mean, how is that going to work out? How did it work out in Argentina? In Argentina in 2017, they floated a 100-year bond at an interest rate of 7.9%. Would you like to know what the inflation rate in Argentina ended up being a couple of years later, Greg? 55%.
Oh, boy.
How would you like to own a bond that's yielding 7%, 7.9%, and your inflation rate is 55%? And the currency you have to pay back that bond in is in dollars. So you have to find all of these a massive amount of pesos to pay back your dollar loans that you can't find. So you're going to, Argentina, which is a serial defaulter, is going to default on that debt. The situation in China, which I hope we can get to in a little bit, is even more dire.
So their bank, they just had the fourth biggest bank, Baoshang Bank, go under, and then they also have another big bank in trouble, and they got a lot of debt, right?
The non-performing loans in China hit a 16-year high, according to Reuters. Now, it's still a very low percentage, but I have to submit to you that why is any bank in trouble in China? I mean, they're state-owned enterprises in China. That's their banking system. Why would any bank be in trouble? The reason why they're in trouble, Greg, is because their currency, the renminbi, and the offshore yuan is in trouble. It broke through 7. So it's weakening. How that works is $1 1 US dollar equals 7 renminbi or 7 yuan, and it's that ratio is going higher. So the yuan is getting weaker. And that's how they're trying to make up for the tariffs that Trump put on, and the additional tariffs that are supposed to go on September 1st, if they want to weaken their currency. But if you weaken, see, this is what happens. If you weaken the yuan too much, and the Chinese are trying to support the currency, they're not really manipulating it lower, they're trying to manipulate it higher. What happens is, if that yuan, if that ratio keeps rising, yuan keeps weakening, the entire Eastern Bloc nations have to depreciate their currencies, or they won't be able to trade with China. They won't be able to export goods to China. So we've been having a 2015, 2016 episode like we had when the Chinese first devalued the yuan, when the S&P dropped 12% in a matter of a few months. So this is a very destabilizing time. And of course, you have the problems in Hong Kong, which was given to back to the Chinese, I think it was 1997. And the promise was that in 50 years, that this one country, two system policy would revert back to the communist autocratic rule of China in 2047. Well, the current leaders in Hong Kong, for some reason, wanted to create this extradition law. And now you're seeing the entire country of Hong Kong virtually shut down, which is a major hub of international finance.
Well, yeah, wait till Mary Barra, who's decided to close plants in America and stop making the Chevy Impala, a very popular car that she just tried to kill by not advertising it for, 2 years. Wait till maybe a couple of neurons will touch together for her making Chevys in China when they start shooting protesters. They're flooding it with the military personnel. Wait till they start clubbing and, treating protesters like baby seals.
Well, God forbid that should happen.
Listen, the Chinese are brutal. Remember Tank Man? Yeah, where is he?
Tiananmen Square. Well, this is as we record this interview, Reuters reported that the military vehicles are gathering in Shenzhen.
Yeah.
It's about a 1.5 mile ride to the island over a bridge into Hong Kong. And then if you get the People's Liberation Army in there, if these students don't go back to school in September, and they start treating them like Tiananmen Square, we could have a major currency crisis.
Well,
international crisis.
You heard Donald Trump say thousands of companies are leaving China, which I think this is what this is all about. Thousands of companies, Donald Trump a couple days ago, thousands of companies are leaving China. He didn't talk about tariffs. He talked about companies leaving China. If you're a CEO and you're building stuff over there and they start shooting people because they're protesting, wow, is that a good place to build something? Is the rest of the world going to buy your product? Oh, made in China, where they shoot people.
That's what people in Hong Kong are really afraid of, Greg. 2047 might sound like it's a long way away, but it isn't. And you know what they do with this dissidents in China? Ask the Christians and some Muslims.
Harvest their organs and sell them on the open market?
They're members of concentration camps in China. I'm sure you have reported on that.
I had people tell me, a big group tell me that they are taking these people, that they are dissidents, and they are harvesting their organs and selling them.
And if you're part of a British rule, democratic Western democracy for 170 some years, and then all of a sudden you're subject to organ harvest, you're going to fight, and that's very destabilizing. I'm not trying to paint a picture of a complete global dystopia, but we have a global recession. We have problems in Argentina. We have problems in Turkey. The European Union is in a recession. Japan is barely clinging into growth, and they're a train wreck over there as well. Central banks have, throughout the world, for the most part, zero room left to do anything about a recession. That's what, by the way, that's what held the global economy together for a few years, was this inexorable move to zeros. They kept on lowering the borrowing costs, until they hit zero and below. Now, you can't tell me that Deutsche Bank is going to be bailed out because instead of a minus 40 basis point deposit rate with the ECB, that they're going to have to pay 50 basis points for their assets that they keep fallow at the European Central Bank. So you reach a point where interest rates can no longer bail you out. They've eked out all of the asset bubble that they've engendered. In other words, you take interest rates lower and asset prices look better and better, and pretty soon that difference reaches its climax, and then that starts to contract. So that's where we're at right now. Interest rates can't bail you out. We have a global recession. We have a debt-disabled world. We have currency wars. I don't mean to sound like Mr. Rickards, but he happens to be correct. Currency wars and trade wars. And I think we're headed towards shooting wars very soon, unfortunately for the people of Hong Kong. And it might not be limited to Hong Kong either. You know, Japan and South Korea aren't getting along very well with their trade issues. So the only hope we have is the Fed is the only central bank on the planet, and they only have 8 rate cuts before they hit 0. And there, by the way, I'll add this. There is virtually 0 room left fiscally in China, Europe, and in the United States. The United States has $22 trillion debt. Our debt to GDP ratio is in total is 350%. China had $2 trillion of debt in the year 2000. They now have $40 trillion of debt, state-directed, unproductive debt that's starting to unravel. We all know about the quadrillion yen debt debacle in Japan. And the European Union is, you know, I don't think Italy is going to borrow its way out of its recession. So this is a very key time for investors. That's why I have a very complicated model that tells me where to be invested. Should I own bonds? Should I short bonds? By the way, the shorting high yield is going to be a huge play coming in the near future. Should I own gold? What percentage? Should I own bond and bond proxies? Should I own tech? Where do you go? You have to have a model that measures the inflation, the dynamics between inflation, deflation, and growth. That's what I have. That's what kept me afloat all of these years. But it's going to get very, very ugly. There's not much central banks and governments can do about it. And here's the thing. This is occurring when the stocks of the United States market are 5% off their all-time record high valuations. So the total market cap to GDP, which is the best measure of the valuation of stocks, I could also throw in median PE and price to sales, they're very close to an all-time record high. So this dysfunction is happening in that context. So if you're sitting there with your investments in a typical wirehouse with, you know, 60% stocks, 50% or some kind of, you know, 60-40 bond stock portfolio, depending on your age, and you think that bonds are going to bail out your stocks, you're sadly mistaken, because there isn't much room for bond prices to go much higher. So you should be on your toes if you're a global international investor.
Have you predicted a couple of years ago that we're going to reach peak central bank confidence? The confidence in central bank is going to peak. And when it peaks and people realize the central banks can no longer bail us out, oh boy, watch out. Have we hit the peak of central bank confidence?
Greg, we've gone from 100% confidence in central banks. This is in 2009. Temporary, that's how we started this interview. It's temporary. We'll take back all that money that we printed. We'll drain the balance sheet back to $800 billion where it was in 2007. And we'll take interest rates back from 0 to 6%, and we'll be great. Everything will be fine. That notion is completely eradicated. It's been eviscerated and obliterated. The faith in central banks, be that the ECB, the PBOC, the Bank of Japan, or the Fed, it is almost completely gone. And if you want proof, look at the dollar price of gold and look at the price of gold in all the other currencies around the world that it is measured in.
And with that, you couldn't have a better ending quote, which I'm going to just wrote down and I'm going to put in there. It's your website. You have free stuff on your website, pentoport.com. You are Michael Pento of Pento Portfolio Strategies, economist and money manager extraordinaire. And plus you're just a nice guy. Listen, thanks for coming on and taking us to school on this your quick 30-minute interview. I really appreciate you coming on, Michael Pento. The website, pentoport.com. Thank you very much for joining us today on USAWatchdog.com.
Thank you, and thank God for USA Watchdog.